For most of modern history, we were told that gold is a relic, a shiny leftover from the past, a barbarous metal that modern finance outgrew. We were told that smart nations moved on to paper, then to digits, then to invisible numbers floating across screens. And for decades, that story felt true. Markets boomed, credit expanded, money multiplied with a keystroke. Gold sat quietly in vaults, dismissed as old-fashioned insurance for paranoid minds. But what if gold was never obsolete? What if it was simply waiting? And what if 2026 is the year it starts sending a warning most people won't recognize until it's too late? This documentary uncovers why gold may become a signal flare in 2026. Not because of superstition, not because of fear, but because of structural pressure building beneath the global financial system. We will explore how the modern money system was built, how it quietly shifted risk onto ordinary people, and why gold tends to move first when trust begins to thin. Not in panic, not in headlines, but in quiet, steady signals. This matters now because money is not abstract. It decides where you live, what you can afford, whether your savings hold value, whether your retirement exists on paper or in reality. If gold begins to move in a certain way, it is not just a market story. It is a message about confidence, stability, and power. And the question is simple: who sees it first? To understand why 2026 could matter, we have to understand how we got here. In 1971, the global monetary system changed. The United States ended the gold standard, which meant dollars were no longer directly backed by physical gold. Instead, money became fiat. Fiat simply means money has value because a government declares it so, and people trust that declaration. Trust replaced metal. Confidence replaced constraint. At first, this seemed like freedom. Without gold limiting supply, governments could create more money to stimulate growth. Central banks, which manage a country's money supply and interest rates, gained enormous flexibility. They could lower rates to encourage borrowing. They could inject liquidity, which means adding money into the financial system during crises. This flexibility prevented collapses. It also built something else: dependence. Over decades, debt expanded. Governments borrowed more. Corporations borrowed more. Households borrowed more. Debt became normal. In fact, it became necessary. Economic growth increasingly relied on expanding credit. When growth slowed, more debt filled the gap. When markets trembled, central banks stepped in. Each rescue reinforced the belief that the system could always be stabilized from above. Most people never notice the trade-off. When money supply expands faster than real goods and services, the value of each unit slowly erodes. That erosion is called inflation. Not always dramatic, often quiet, but persistent. And when inflation rises faster than wages, purchasing power declines. That means your money buys less, even if the number in your bank account stays the same. Gold behaves differently. It cannot be printed. It cannot be created by policy. It is mined slowly, physically, at high cost. That scarcity is its defining feature. For centuries, gold has acted as a store of value, which means a way to preserve purchasing power over long periods. When trust in paper systems weakens, gold tends to strengthen. Not because it is magical, but because it is finite. Consider a small business owner named Arjun. In 2021, his savings covered nearly a year of expenses. By 2024, despite working harder, those same savings covered only 8 months. Costs rose faster than revenue. Rent increased. Supplies increased. Insurance increased. The numbers in his account looked stable, but their power had quietly declined. He began buying small amounts of gold, not out of fear, but out of uncertainty. He did not trust headlines. He trusted math. Now consider a different moment. A central bank increases gold purchases quietly over several quarters. This is not theory. Over recent years, many central banks around the world have increased gold reserves. They do not do this for decoration. They do it to diversify away from dependence on another country's currency. When institutions that create money start accumulating hard assets, it signals something deeper, hedging against instability. So why 2026? Because multiple pressures are converging. Global debt levels are historically high. Interest payments on that debt are rising as rates remain elevated. Geopolitical tensions are fragmenting trade relationships. Countries are exploring alternative payment systems to reduce reliance on the US dollar. When global trust networks shift, gold often becomes a neutral anchor. It belongs to no single government. There is another layer most people were never told. In the current system, risk tends to flow downward. When markets crash, asset prices fall, and ordinary investors suffer first. When inflation rises, households feel it immediately at grocery stores and fuel pumps. But when money is printed to stabilize the system, that new money enters through financial institutions and asset markets. Assets often recover faster than wages. This creates a widening gap. Gold sits outside that loop. It does not generate yield like stocks or bonds. It does not promise growth. It simply holds value when confidence in other assets weakens. That is why large institutions treat it as insurance. Yet ordinary savers are often told it is unproductive. The truth is more nuanced. Gold does not build wealth. It protects it during instability. In 2026, if we see sustained gold accumulation by central banks, rising retail demand, and increasing volatility in currency markets, that combination could be a warning. Not of collapse, but of recalibration. Gold tends to move before headlines admit stress. It reflects behavior, not speeches. Think about a young couple saving for a home. They watch mortgage rates fluctuate. They watch prices remain stubbornly high. They keep cash in a savings account earning modest interest while inflation quietly eats away at real value. They are told to stay patient, to trust the cycle. But what if the cycle is not temporary? What if the system itself has entered a phase where stability requires ongoing money expansion? The real rule of the game is this. In a debt-based system, growth must continue to service existing debt. If growth slows, pressure builds. Policymakers face difficult choices. Raise rates to control inflation and risk recession. Or lower rates to stimulate growth and risk currency weakness. Gold reacts to these dilemmas because it sits at the intersection of inflation fears and currency trust. This does not mean gold will skyrocket overnight. It means its behavior could signal shifting confidence. If it rises steadily despite strong equity markets, it may indicate quiet hedging. If central banks continue diversifying reserves away from dominant currencies, it may indicate structural realignment. These are not dramatic events. They are slow adjustments with long shadows. The hidden cost in the current system is not just inflation. It is complacency. Many people believe their savings are safe because numbers increase nominally. Nominal means in name only. Real value, adjusted for inflation, tells a different story. When real returns are negative, even stable accounts lose purchasing power. Gold tends to perform best when real returns on cash and bonds are low or negative. What most people were taught is simple. Work hard, save money, invest in growth assets, retire comfortably. That formula worked in long periods of expanding stability. But in high-debt environments with persistent monetary intervention, the landscape shifts. The game changes subtly. Preservation becomes as important as growth. None of this guarantees crisis in 2026. It suggests signals. Gold does not shout. It reflects. If it begins climbing while official narratives insist everything is under control, pay attention. If governments increase reserves quietly while telling citizens not to worry, ask why. If debt continues expanding faster than real productivity, consider the long-term implications. There is a grounded way forward. Diversification remains key. Diversification means not relying on a single asset, currency, or strategy. Holding some real assets. Keeping emergency savings. Avoiding excessive debt. Understanding inflation and real returns. These are not dramatic moves. They are disciplined ones. Gold should not be worshipped. It should be understood. A small allocation for many acts as insurance against currency erosion and systemic stress. The goal is not speculation. It is resilience. If this helped you see things more clearly, take a moment to like the video, share your thoughts in the comments, and subscribe to Rise and Ruin, Power of Wealth for more documentaries on money, power, and the forces shaping our future. In the end, gold does not predict the future. It measures trust. And trust is the foundation of every financial system ever built. When trust is abundant, gold rests. When trust thins, it rises. So watch carefully in 2026. Not with fear, with awareness. Because the first warnings rarely come from politicians or headlines. They come from quiet signals most people were taught to ignore.